Hey traders, I'm Ali from FX Scouts. So today we're going to jump into one of the most effective trading patterns for trading the trend, and that is the bull flag or the bear flag. And flag patterns are effective because they help you to quantify your risk, but they also help you to structure your trades. Now, whether you're a beginner or you're a more seasoned trader, understanding these patterns can really help your trading. Just a reminder that forex trading is risky and most traders lose money. This video is for educational purposes only, and all charts displayed are historical and do not reflect the current market price. Now, the reason I want to talk to you about the bull flag is that it's such an important pattern for trend trading. In the right market conditions, it can really help you to manage your risk and to really find those perfect entry points. Before we get started, I want to show you what the bull flag is and why it is so effective. So bull flag is a chart pattern that begins with a strong upward momentum, often referred to as the drive, and it usually occurs in the context of a trend. Now, this drive is followed by a period of consolidation where the price pulls back slightly, but it stays within quite a tight range. This forms the flag. And the idea here is that once the price has gone into this consolidative pattern, it will then continue in the direction of the original trend. And this creates an opportunity for a trader to enter at a better price before gaining on the trend, but also helps a trader to manage their risk better. Now, the structure of a flag is very simple, but it's very powerful as well. So first, we identify a strong, clean upward move, and this signals that the buyers are in control. Next, we wait for the price to consolidate into that recognizable flag shape. Now, this is where the market is taking a breath, or where traders may be taking profits before the trend moves higher in the same direction. And once the price breaks above the high of the flag, that's when we enter the trade. And we wait for it basically to continue in the direction of that move. So I want to show you a trading example. So here we have the DAX on the hourly time frame, and we see the days open and a strong upward drive, which is often what happens with the open of these indices. It is followed then by consolidation, and this forms the flag. Then as the price breaks above the high of the flag, we take our entry. So where do we set our stop? Well, as I said before, flags help you to quantify your risk. So we place it just below the low of the flag, and this keeps our risk controlled, and it also keeps our structure in place. And for our target, we use a 2-to-1 risk-reward ratio, which means our potential profit is double our risk. So why is a structured approach so important when trading the trend? So what I find is that when traders see a trend, they often get FOMO or fear of missing out. And you think, damn, I should jump in on this trend right now. But what happens is that you often then don't know where to set your stop loss because you don't have any rules for jumping in the trend at that moment. And therefore, it messes up your risk-reward ratio because now your profit target is almost too high or unreasonably high, and you know that the price might not get there. By waiting for the flag to form and break, you actually are quantifying your risk because now you have rules in place and you can then set a profit target that is reasonable for the amount of risk that you're taking on. So by waiting for the flag to form and for price to break above that flag pattern, you're actually quantifying your risk. You have a specific place to set your stop and you have a clear target in mind, which helps you avoid emotional decisions and keep your discipline in check. Now, of course, not every trade is going to work out. You are going to have some trades that will move against you, even if you do find these perfect setups. And that's fine, because with the 2-to-1 risk-reward ratio, even if you're only right 50% of the time, you will still end up being profitable. And that's what trading's about. It's about managing your risk, because you are not going to be right every single time. And this is the beauty of the bull flag pattern, and it lies in its simplicity and its repeatability. It gives you a structured way to enter the markets with well-defined risk. And by focusing on these types of patterns like the bull flag, which is only one among many different patterns you can look at for trend trading, it gives you an edge while staying away from huge losses. And just at the end here, I just want to say that trading is really about pattern recognition, excellent risk management, and discipline. And if you can incorporate all those aspects into your trading, you will end up being consistently profitable over the long term. Thanks so much for watching. Please remember to like and subscribe for more videos and trading tips, and I'll see you in the next video.